Another thing that may feature quite heavily in 2011 is the trend of rising inflation. In actual fact, in the last year itself, we have seen inflation pressure creeping up. China has reported the highest inflation numbers since the crisis, and even in Singapore, inflation numbers have climbed above 3%. The latest number is about 3.8%, and in 2011, inflation in Singapore might even exceed 4%. So in actual fact, one of the things that the middle class or the average person need to be concerned about is rising inflation and how that can actually cut down your purchasing power. For the average person, the simplest way to actually to hedge against inflation is possibly to have some exposure to gold and silver. And of course, gold prices right now is about $1,360, and silver is about 28 to 29 US dollars. Between the two right now, the current ratio between gold and silver price, if you use 1360 divided by 28, you get a number of about 48. So current gold-silver ratio is about 48 times. Historically, gold-silver ratio has ranged between as low as 16 times to as high as about 89 times. But the average mean is about 30 times. So if gold-silver ratio were to go to a ratio of 30 times, that might mean silver prices rising from currently 28 US dollars to about 44 US dollars. That is considering if gold prices stay at current levels of about $1,360. But of course, if gold prices go up even further, then there might be potential for silver prices to move up even higher. So really between the two, if someone does not have any exposure to gold nor silver, it will appear that silver will be a better bet because the gold-silver ratio is in silver's favor. There is a chance that the ratio would narrow, and with that, the potential for silver prices to go up more is higher than the chance for gold prices.